again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is December 1st. It's a Thursday and there's a lot of economic data. Let's get right to it and thanks for watching. So let's go back on Tuesday when I provided my update, market insights and observations. And I indicated, if you watched or tuned in, I basically said the most important conversation of the week is going to be the Federal Reserve Chairman Jerome Powell's conversation at the Brookings Institute, which was going to happen actually Wednesday. That happened yesterday. And as soon as Federal Reserve Chairman spoke about the economy and was asked sort of Q&A, the markets, which were lower in earlier trading yesterday, just turned right around and all bets were off, and the markets, the bulls were fully in charge of the market. In fact, markets literally ran hundreds of points by day's end based upon what Jerome Powell said. And this is what we predicted as expected, which was, what did he say? He actually said this: given the number of interest rate hikes that we've done year to date, we're going to now go into cruise control potentially some point in time in the future, whether it's the next 3 months or 6 months, which means that we could see a peak in interest rates. At least that's what the inverted yield curve is saying. Hey, listen, the economy's sick right now. And don't forget about the measured impact of what you've already done. So the cumulative effect of your rate hikes, what have they done? Now, let's ask about this. If we just look around the economy right now, if we started going back even 11 months earlier, we started the year at 25 basis points for a Fed funds rate coming into this year. And the Federal Reserve has done 75 basis points by 4 times, pushing us into the four handle, not only on the 10-year and the 2-year, but on interest rates in general. What does that mean to the consumer? Everything's gone up, from the consumer debt, the credit card sort of interest on your money that's compounding for the consumer. We're seeing that in the economic data that's actually playing out right now. But more importantly, it's housing. We're seeing housing come to a standstill in the month of October, as we're seeing some of the November and October information that's hitting. Now, why is that? It's simply because your affordability in housing has gone from up 2/3. You're looking at, earlier this year, affordability was, let's call it a sub 3% mortgage. Now, in the month of October and November, we saw 7% on that mortgage. Now, I've seen a 7%. That's, what I've seen in my first home over, 25 years ago. And there was higher rates even, 30, 40 years ago. So the economy can handle it. It's all about the imbalance and how it works its way through, adjusting to higher interest rates. But this is different in the sense that the key was, and this is what Jerome Powell is ultimately sort of indicating, it's the speed of which he got there, right? So when interest rates rise, they go specifically on a measured pace, but the speed and the quickness that we've seen has had asset devaluation and destruction in all of the asset classes, as we've talked about, we've seen year to date. So what happens when the Federal Reserve, I wouldn't say becomes dovish, but less hawkish is the tone I would take away from yesterday? Markets see a relief at some point in time in 2023. Ultimately, if we look at the economic data that's playing out, it's showing that the Federal Reserve has had an impact negatively on the economy. Again, the JOLTS number earlier this week, the jobs opening, less jobs opening. We're seeing unemployment number. In fact, tomorrow, the jobs number tomorrow is going to be the key to whether we see a sustained rally or if we sell off. And inside that jobs report on Friday, we want to look for one thing. It's called the wage inflation. If wages are higher in terms of inflation on wages because there's such demand for individuals and you have to pay them more for employees. So there's that wage inflation that you see take place, which from a small business owner or any business, that's your wage line on your P&L or your SG&A line as you run a business. That's your number one expense, right? You can't run a business without your employees. So if that's increasing higher than expected or even an outside number to the upside tomorrow, meaning too hot, we could see lower lows in terms of markets selling off. Now, if it comes in line or below expectations, we could see markets rally. This Santa Claus rally could be in full effect, given on top of what the Federal Reserve comments were yesterday. So we're going to pay attention to all eyes on the real-time economic data that's moving markets, and hopefully I explained it as to why and the rationale. So we're talking about the inflation that matters, housing affordability, obviously, and wages. And wages have to be impacted by what the Federal Reserve is doing in terms of slowing the economy, making small business owners and businesses think twice about hiring, providing opportunity and sort of more slack in the labor market. That's our update for today. We appreciate you tuning in. And again, like and subscribe and share to friends and family. We'll see you again next time.